Welcome to Fall into ETF Investing. On today's special episode, our panel of guest speakers will be discussing rising rates and fixed income ETFs, what you need to know.
Welcome to ETF Market Insights. I'm Erin Allen, and this is Danielle Nezel, and we're your hosts of ETF Market Insights. And today we're really excited to be kicking off our special edition Fall into ETF Investing.
Erin and I, we are out of our home offices. We are right here in studio together. We're also talking with experts in the industry. We're bringing everyone together to bring you, the do-it-yourself investor, a fantastic educational experience. Here at ETF Market Insights, we're all about providing DIY investors the tools they need to navigate these markets and manage their own investment portfolios.
Just a reminder before we do get started that we're not providing you investment advice or investment recommendations today. As Danielle mentioned, our show is all about providing education for DIY investors.
Our next session is all about fixed income investing and how are fixed income ETFs responding to this very high interest rate environment.
Our special guest host today is Adrian Barr, also known as Canadian in a T-shirt. He's got his own YouTube channel, and he's a very enthusiastic content creator on topics from personal finance to investing. So Adrian, I'll turn it over to you. Take it away.
Welcome to ETF Market Insights. I'm Adrian Barr, the Canadian in a T-shirt. Today, we're going to break down fixed income investing for Canadians. We will break down how to manage a fixed income portfolio in today's environment, some diversification techniques, and what to consider when preparing your portfolio for the next rate decision by the Bank of Canada. Today, I have the pleasure of being joined by Marina Metz, Managing Director of FTSE Russell, one of the largest fixed income index providers in the world, and Matt Montemero, BMO ETF's very own fixed income ETF portfolio manager. Thank you both for joining me today. I'm looking forward to our discussion. Let's jump right in. Marina, Matt, can you provide us an overview of the interest rate environment and walk us through the relationship between bonds and interest rates and what investors need to be aware of?
Sure. So at the moment, we seem to be in this very interesting holding period with the Bank of Canada taking a pause in September as it evaluates presumably economic indicators coming off its very aggressive rate hike regime over the last little while. Those rate hikes have pushed the overnight rate to 5% right now, and have been very, very aggressively implemented. What does seem to be firmly the case is that the era of near zero interest rates and where the bank was the backstop for controlling economic volatility in all situations are firmly behind us. And the bank is set firmly on controlling the inflation towards 2% mantra target. What has this meant for investors? So on the one hand, we have recessionary indicators, and the technical recession indicators, which is the steep inversion of the 10s, 2s, 30s, 2s yields, are in place. We've got very high debt to income ratios. And so there is some prediction of potential recession coming into next year and possible speculation of the bank even starting to ease. However, on the other side, we have not seen the deep recession that was predicted take hold. We have not seen credit defaults. We have not seen a rise in spreads. In fact, we've seen some credit spread tightening throughout 2023. And the forecasts are predicting some growth. Yes, slow down, but some growth nonetheless. So what this all kind of leads into is this potential scenario of a higher for longer. So taking us back to a 3 to 6% kind of interest rate environment, commonly referred to as the Goldilocks era of the kind of early 2000s, where inflation is not too high, not too low, and the yield environment not too high, not too low. And we see money moving through the system. As investors, we think kind of prepare for that and place bets on that kind of economy. What it also means, though, is quite an exciting opportunity, we think, for investors today. As I mentioned, yields have been pushed up to really high levels. And so, if you think about that from the perspective of a broad measure of Canadian fixed income market, which is the FTSE Canada Universe Bond Index, it's currently sitting at a yield rate of about 5%, which is up from below 2 just 3 years ago. Yields on short-term corporate credit through the lens of the FTSE Canada short-term corporate index are pushing 6%. These are quite high. So investors are getting paid quite well to take a bet and sit on the sidelines and wait while the market kind of readjusts and we have a much clearer indication of where we're heading. If you take a step back to think of why that's the case, so this measure of yield, or effectively, as we think about it, the performance of a bond, is made up typically of two indicators. On the one hand, you have the predictable cash flow of fixed income instruments. Those are driven by the coupon being paid on a security. When a bond is first issued, the coupon is set at the then prevalent market rate. So today, those rates are pretty high, right? So you're going up from that 5% coupon. So investors are getting good cash flow coming in. The other part of this equation is the kind of income appreciation. What I mean by that is bonds issued historically at lower coupon rates than what is sitting in the market today have been repriced, right? So they've repriced below par or below that $100 mark. However, the investor is still guaranteed to get that $100 at the end of that bond's life. So coming into the market today, you're also gaining the appreciation from where that bond is being priced today, given how quickly those rates have risen, to the $100 that you're going to get at the end. So those two taken together result in a yield indicator, which is the annualized expected return on those bond portfolios. And those are quite high, much higher than we've seen at any rate in the last couple of years.
And I can just follow up on that with what Marina was saying in terms of expectations of return for fixed income investors. And the paradigm has definitely shifted. And I think fixed income investors can now get both income and stability from that fixed income part of their book. So, Marina had mentioned, higher rates for longer. This is a stance that we've had for much of the year. And the Fed has now come outright and said, expect higher rates for longer. They want these higher rates to make their way through the system. Generally, rate hikes take 18 to 24 months to make a real full economic impact. We're getting to that point kind of full way through 2024. So for us, I think we're going to see some stability in higher rates. I think that's a good thing for fixed income investors. But I think one thing we need to look at is, how are you positioned? How are fixed income investors positioning? What risks do you have within your portfolio? And I think that's something that often investors don't really look at from a duration perspective. Where are you along the yield curve? Are you short, mid, long? That's going to have an impact in a rising rate environment. That's going to have a different impact in a flat environment. And that's going to have a different impact in a cutting environment. So if I look forward, what's the market pricing in right now? The market is pricing in stability. The Bank of Canada and the Fed are expected to sit on their hands for a little bit, sit on the sidelines. The earliest hikes are priced in for the Fed in the US for around June of next year, and in the Bank of Canada for September of next year. I personally think it's going to be longer. I think they're going to wait till the end of 2024 before they even risk coming in and cutting interest rates. So as an investor, what do you want to do? What have we seen? We've seen investors flock to the short end. They've wanted to reduce that interest rate exposure. They want to reduce their duration exposure. And that's been the prevailing trade for 12, and I think it's going to continue for another 6 to 12 months. But this is where fixed income becomes interesting, because tactical investors, they see opportunities in the market, and this is where being able to segment your fixed income exposure allows to opportunities. So just this summer, we've seen long-term rates, as cuts have been pushed out through 2024, we've seen long-term rates rise. That leads an opportunity for investors to potentially add duration tactically to a portfolio. So I think what I really wanted to say in terms of investors, know the risk you're taking, figure out how you feel about that risk, and then adjust accordingly using ETFs, funds, different bonds, and that's what I think we'll talk about for the rest of the conversation.
No, that's wonderful. I think a lot of Canadians are really kind of apprehensive and kind of cautious about how the interest rates are going to affect their portfolio in the future. But I think I think Canadians all across the board really appreciate this kind of insight. Thank you. Can you walk us through how you look at the different segments of the fixed income market and how this gives investors flexibility to position themselves for their outlook on the markets?
Sure. So as Matt mentioned, today, more than ever in the last decade, it's important for investors to understand and appreciate what they actually own inside their portfolios, to understand how the behavior of the particular asset class is driven within their book and how it might react to the interest rate environment and the changes in those interest rate environments. So if we take a look at it through even the lens of the broadest, widest measure of Canadian bond allocations, which is the FTSE Canada Universe Bond Index, the investors that are looking to take a view on markets, period, and allocate to fixed income, which, as we said, is quite attractive these days, can position themselves and invest in that broad-based index directly. However, not every bond included within that index, which tracks government and government agency securities, provincial issuance, and Canadian corporates, is created equally. And each of those securities has a very unique structure around them that influences how those securities react to the positioning in the market. So what are these broad kind of segments? So the first peer grouping, if you will, would be the term. So all bonds mature, hence the maturity date of that bond influences where it sits relative to the yield curve. So term buckets. The second kind of indicator would be industry segments or industry segments. So the index peer groups these securities by federal or provincial or corporates. And even within corporates, energy is peer grouped together versus financials, for example. The third, I think, broad kind of market indicator is a view on the quality of the credit into which you're investing. And so informed by the rating of that bond. So the peer groups there would be AA, single A, triple B. Right? So once you measure these kind of peer groups and you take a look at a little bit more in depth, you soon recognize that each of these peer groups behave slightly differently as the market moves and as the rate moves. So one of the probably easiest examples to think about right now, and as Matt was mentioning, the short term. As the curve inverted, short-dated bonds performed different than their long-dated counterparts. And if you take a look back at the index, for example, short federals outperformed their long-dated counterparts. In provincials, however, because of the spread adjustment, because these securities do carry some spread over the underlying, the position is inverted. So long provincials actually did better. When you think about the corporate segment, financials outperformed on average the rest of the corporate components. So all of these pieces move and behave slightly different, and it's super important for investors to understand what's within their portfolio. As we, of course, mentioned, there's market dislocation, and this asymmetry in the market also creates opportunities for investors. So you want to be able to, when you think about your tactical allocation, you want to think about the fact, where am I putting that money to work, and where am I putting that money to work right now over the short or the long term? Right? In addition to the fixed rate environment, there are specific instruments in the market that are also structured slightly differently that can be positioned against these kind of rising rate environments. So what do I mean by those? There are, for example, floating rate notes that adjust the coupon or the payment that the investor receives as the rate changes. There are inflation-linked or real return bonds in the context of Canada that are CPI or inflation adjusted, etc. What I think is really interesting and really quite exciting for the investor today versus the last time we were in this kind of a rate environment 20 years ago is the innovation that allows investors to really express that tactical allocation view. And mainly I'm speaking about ETFs, right? Because if you wanted to in the past to try to move your allocations or go from short to long in a fairly short period of time, quite difficult to trade. And an individual kind of investor would have had trouble sourcing those bonds, trading that. Today, they don't have to. There's been a proliferation of product. There are investment products and investment vehicles that track all of these various buckets that I just talked about. So federals versus corporates, short versus long. And investors now have a lot of choice in being able to express their own tactical market view into their asset allocation or trading policies.
And just follow up there, Marina, in terms of the segmentation of the fixed income market really gives the power back to investors. And, we've seen a changing of risk dynamics in the fixed income market where, traditionally 20 years ago when Marina said we were in this last yield environment, set it and forget it. A single fixed income solution was common for many investors. And now in an environment where fixed income and rate volatility is driving overall market volatility, it's a new risk paradigm, and it requires investors to be more precise, more deliberate in their fixed income exposures. Set it and forget it just simply doesn't work anymore. And so ETFs open up that toolkit for investors to pick and choose the exact exposure that they want. So at BMO, we break down that the FTSE Canada universe into 9 subcomponents. We call it our 3x3 matrix. We break it down by term, so short, mid, long, and by credit, federal, provincial, corporate. And that allows investors to pick exactly where they want to be along the yield and credit curve. And so as the market changes, as dynamics change, as maybe it's a risk on or risk off sentiment, those ETFs, it's a single trade and you get diversification to that very precise part of the curve, that precise exposure. And that's been a game changer for a lot of investors about how to navigate these volatile and difficult times. So when we look forward and we're looking at what we see as opportunities, as I said, we've seen that migration into the short term. Two of our ETFs, ZST and ZCS, have been some of our biggest sellers as investors take off duration risk, reduce their overall interest rate sensitivity, and look to capture those higher 5 to 6% yields. But as markets change, as we start to see the reality of rate cuts actually coming to fruition, you're going to see investors look to add duration, take advantage of that sell-off, take advantage of lower rates coming down. And so that's where having that flexibility, having those ETF tools, being able to move from one to the other in quick and efficient ways becomes very important for investors to create better outcomes.
Wonderful, yeah. So I know a lot of Canadians, it's a very scary market for them right now. But like you said, they have more options than ever to kind of navigate this and hopefully come out ahead. And you did mention duration a few times. So Matt, this is a question for you. Can you walk us through duration and how investors should look at it in regards to rising rates?
Yeah, sure. So Marina and I have already talked about duration a couple times when we've thrown it out there, but let's take a step back. Duration is a key risk metric, one of the key risk metrics that fixed income managers and investors should look at and consider. It is a bond price sensitivity to a change in interest rates. So let's take a step back. Bond 101, yields go up, bond prices come down. Yields come down, bond prices go up. So if you took a bond or an ETF that has a duration of 7, let's say, that's 7 years, and you saw a parallel shift in the yield curve, an increase of 1%, right? Interest rates moved up 1%. The expectation from a duration, from a quantitative measure, would be that your expectation of the bond price would be to fall by 7% with a duration of 7. Vice versa, if you think rates are going to come down 1%, you would expect that bond price to go up 7%. So that's your sensitivity. So if you think you're in an environment of rapidly rising rates, 2022, for example, what you want to do is reduce that interest rate exposure, reduce that duration, move to the short end to try to protect yourself on the downside. On the flip side, if you think rate cuts are coming sooner, you think a recession is coming, that hard landing scenario, and you think that the Fed or the Bank of Canada is going to have to cut rates sooner, then you want to add duration because that's where you're going to get that volatility offset, but that's where you're going to get some upside from the cutting of rates. So duration is important to understand from both a bond perspective and an ETF perspective from the overall portfolio of bonds. And that just gives you that general idea, as rates move, as they move around, what's my downside and what's my upside? And I think that's what we're seeing. Last year was a very tough year for the market, but I think now that we're going to be in a little bit more stable environment, duration could be a benefit for some investors as we look forward.
No, that's an excellent point. With time is one of the most important factors with any investment. And like you guys have both mentioned, not all bonds are created equally. So you definitely have to consider the duration when you're making those options. Marina, this is a question for you. Right now, where are we with inflation and how does inflation affect fixed income investors?
Yeah, so inflation has been probably one of the most watched indicators over the last couple of years. It's the key cornerstone of the central bank policy. Everybody has expressed their view that controlling inflation is the one key metric that's driving all monetary policy decisions, it seems like, at the moment. Now, given the kind of very, very heavy-handed rise in interest rates, inflation has come down. However, recent data has indicated that not all of it has been kind of controlled. We've seen still a continued consumer demand as we think consumers are spending those COVID savings that everybody is stacked up. So that's held up quite nicely. And labor continues to be quite strong, which are the counter indicators to inflation. And so the Bank of Canada just recently revised their projection, saying that we're going to be hitting around 3% or staying around 3% going into 2024, easing towards a 2% target inflation in 2025. Now, why is this such a key indicator for all investors and why we've all been kind of watching this and positioning portfolios? So if we think about what inflation really is, it's a general rise in the average prices for goods and services in an economy, right? Why is that important? Because technically it tends to reduce purchasing power of the dollar. With respect to fixed income particularly, these are fixed rate instruments. So we talked about the fact that investors investing in bonds, you're locking in your cash rate, right? And so when you lock that in while the rest of the pricing goes up, you become relatively cheaper versus the rest of the economy, right? So it creates this kind of relationship where as inflation heats up, the value of those bonds tends to come down. So if you think about it in terms of rates, a expected return or yield of about 5% with inflation of 2 means a real rate or a real yield of 3. That same 5% rate with an inflation of, let's say, 7% actually puts you into kind of negative territory. And it's those real yield numbers. That's really what the banks are trying to control for. And we've seen certainly improvement in that. As we said, it's looking like we're a little bit kind of into a steady for longer environment. The other interesting kind of component here is that to counteract inflation, the typical monetary policy trigger is to raise interest rates. And so as Matt and I both just said, rising rates mean some reduction in the pricing of bonds. What it does look like, though, I think for what we're seeing is a lot of that has already been priced into the market. The kind of very aggressive, very steep rate hikes have kind of come through the market. The market is coming back to what appears to be this longer kind of steady state equilibrium. And so we think a lot of that adjustment and a lot of the volatility from that adjustment seems to have already been priced into market. But there are also a lot of securities that, from an investor perspective, lower the exposure to the volatility of those inflationary periods, right? So short-dated bonds, certainly, we've talked a lot about that today. The inflation-linked or securities that adjust in conjunction with inflation provide that. And there's a number of reset environments that allow investors to kind of position themselves for that higher rate, steady rate environment.
Wonderful, yeah.
Yeah, and so, we look at where we were a year ago. We're in a much better place from an inflation perspective.
Sure.
We're still not there yet, though. And I think that's the important part that for investors to understand, in that we are still, quite a bit higher than both the Fed and Bank of Canada's target. And there can always be upside surprises. We saw it in August, hot CPI print. And that's why if investors are looking to protect themselves, a lot of people say, oh, well, that was yesterday's issue. Well, we're still there, and the Bank of Canada and the Fed have both identified inflation, as Marina said, as their top priority. They are not going to stop. They're not going to ease rates. They're not going to drop rates until inflation is fully under control. So for me, I think there's still some risk in inflation. I think looking at something like U.S. TIPS or Canadian real return bonds, those provide you protection from upside surprises in CPI. And so I look at something from an ETF perspective like ZTIP. That's our 0 to 5 year U.S. TIPS ETF, or TIPS TIPS, which gives you the full term exposure. For my preference right now, I think ZTIP, getting that short exposure. So again, you're reducing your duration risk there, but you're still providing some inflation protection from the rest of your portfolio. I think it's an excellent complement to the rest of your core. And I think it's something that's going to be still topical for 6 to 12 months. Beyond that, I think we're going to have, if we continue with the higher rates for longer, I think we're going to make a meaningful enough dent in inflation that, I don't think inflation protected securities will be in every portfolio going forward. But I think there's a place right now, 6 to 12 months, I think there's still enough of a risk of upside surprises, enough of sticky inflation throughout the system that adding some protection there will do investors a very good thing from a portfolio context.
Oh, that's wonderful to know. And let's hope that, inflation does eventually reach those 2% targets that we're aiming for. And you did mention a few protection strategies, but can you kind of elaborate a little bit more on that? What are some ways that investors can protect themselves from inflation risk in their fixed income portfolio?
Yeah, sure. So the main way to protect yourself is using, in Canada, it's Canadian real return bonds. In the US, it is US TIPS. So it's Treasury Inflation Protected Securities. And both of them are indexed to CPI. So basically, you are getting a real yield, you're getting that protection from CPI, from that CPI that is generated in the system. So, from an investor point of view, what you're really using those securities for is upside surprises. So when inflation surprises on the upside, that's when TIPS or real return bonds, that's when they protect the investor on the downside. So that's what we're looking for in an environment where we're getting higher inflation than expected. That's when you want to use TIPS within your portfolio. So that's when I look forward. I think, definitely we should have had TIPS about a year ago, but now there's still a place for them. I think the place is, maybe a limited time frame, 6 to 12 months, but there's still a place even though we're at a lower absolute number of CPI.
No, that's great to know, right? I mean, it's at least investors aren't on their own, right? They're not just at the mercy of inflation rates. There are strategies and ways to kind of accommodate for that and hopefully smooth the ride for them. We're seeing right now, money market is paying over 5% these days. Can investors expect this to continue? And how can they look at these products relative to GICs, let's say?
Yeah, so I can take this one. And, I think that higher rates for longer, I think I've said it maybe 5 or 6 times today, but I think that's really the theme we're here. And I think if that comes to fruition, then yes, those short-term rates are going to be stable for at a minimum 12 months, but I think even further. And I think investors can take advantage of that positioning. Again, Marina had said it, I think I brought it up a little bit with that inverted yield curve where you're getting paid to take less risk on the curve because of that inversion of the yield curve, because shorter term rates have risen faster than longer term rates. So from a risk return perspective, investors look at it and say, well, I'm literally getting paid 5 to 6% yields to sit on the sidelines, if it's in a GIC, if it's in a short-term fixed income ETF, if it's in a HISA product. And we're seeing investors dive into that segment of the market because I think it makes intuitive sense to just take risk off the table and still earn an attractive 5 to 6% yield. We haven't seen that in 20 years. So a lot of investors are saying, back up the truck. I'm okay with that risk trade-off. But when I talk to investors and they're saying, okay, well, GIC versus an ETF, why would I choose one over the other? Well, an ETF provides you flexibility. In a volatile market, in a GIC, you have to lock in for 6, 12, 18, 24 months. In a volatile market, do you want to do that? Do you want to say, I know for sure that we're going to be in a different rate environment in 6 months, 12 months? If you use a GIC, you're basically saying, I'm going to invest in this and I'm going to figure it out at maturity, 18, 24 months from now. The ETF provides that same top level yield, but gives you the flexibility. If things change, if we haven't changed in our interest rate regime, their policy, if any geopolitical things change, you can now reallocate, you can rebalance, you can put things, maybe you want long duration, maybe you want some equity market exposure. The ETF leads and gives you flexibility. And so at BMO, we offer several options depending on your risk tolerance and profile. We have ZMMK, which is our money market, most conservative Canadian ETF. We have ZST for those who want a little bit more yield. It's close to a 6% yield right now. And then in the US, who have US dollar exposure, you have ZUCM, which is a US T-bill, again, very conservative. And then you have ZUS.U, which is, again, that credit heavy. That one you're getting above a 6% yield right now. So, a lot of different options for that short-term investor. And I think if you look at it, you're getting the same yield top level. Give yourself the flexibility. Give yourself the ability to back out of that trade, rebalance, reallocate when in an environment where you need it.
That's wonderful. It's good to have that flexibility, right? You're not kind of locked in and then you can't do anything about it, right? That's great to hear. So Marina and Matt, thank you so much. It's been a pleasure and really great insights across the board. It certainly is an interesting environment for bonds and Canadians are always kind of looking for more information on this topic. So thank you to BMO ETFs for continuing to host these educational segments for DIY investors. It's been a pleasure hosting the season. Thank you, and I'll see you next time.